Money Matters, brought to you by ANSA Bank.
If you're interested in getting a loan, buying a new car, taking out a mortgage, or just putting away some money to save, did you know there's an actual cost to borrowing or saving money? That's pretty much the interest rate. Here are a few points to help you better understand interest rates and the impact it has on your finances. 1. Let's start with the basics. What is an interest rate? An interest rate is the percentage of a loan or deposit that is charged or paid over a certain period of time. Interest rates can be fixed, meaning they remain the same for the entire term of the loan or deposit, or variable, meaning they can change over time based on market conditions. When you borrow money, interest is the cost of borrowing. It is typically expressed as an annual percentage of the loan. When you save money, interest is the rate your bank or building society will pay you to borrow your money. And guess what? The money you earn on your savings is also called interest. 2. What is the interest charged on a loan? When you borrow money, you pay back the original loaned amount, called capital, plus the interest. Let's say you borrow $100,000 from a bank. If your loan attracts an annual interest of 10%, you will have to pay back $100,000 plus 10% interest, that's $10,000. So $110,000 is the amount you will have to pay back after 1 year. Now, the total might be different if you borrow the money over a longer or shorter period. Banks also consider your credit risk or history. Those with higher credit risk may face higher interest rates to compensate for the increased likelihood of default. You can lower your interest rate by providing collateral, assets such as real estate, a vehicle, and other valuable property to secure a loan. By offering an asset as security, borrowers may reduce the perceived risk for lenders, leading to more favorable interest rates. 3. What about private loan borrowing? Private lenders also provide loans to borrowers, but their terms and conditions might differ from the conventional loans obtained from banks or financial institutions. Banks, however, tend to offer more competitive interest rates, especially for individuals with good credit scores. 4. What are interest rates on deposits? People deposit money in banks and financial institutions, and dependent on interest rates, they accumulate additional savings. 5. What is compound interest? Compound interest is interest that is calculated on the initial principal or capital, which also includes all the accumulated interest from previous periods on a deposit or loan. In other words, it's interest on interest. With compound interest, the amount of interest accrued grows exponentially over time, as the interest earned in previous periods is added to the principal of the next calculation. Example, if you have $100 and it earns 5% interest each year, you will have $105 at the end of year 1, $110.25 at the end of year 2, and $115.76 at the end of year 3. Your compounded interest at the end of the 3 years is $15.76. Remember, understanding the interest rate is essential to investing wisely, managing loans, and ultimately having a successful financial journey.
Money Matters, brought to you by ANSA Bank.